Hello and welcome to Earnings Echo. We put together the most important information about HIMS and Hers Health, Inc. Um, if you're looking at their Q1 2026 earnings today, you are probably seeing this massive contradiction right at the top of the income statement.
Yeah, the top line data is completely split. So Q1 revenue hit $608 million, which is up 4% year over year, and management actually raised their full year guidance massively.
Right, to a range of like 2.8 to 3.0 billion dollars.
Exactly, which is a nearly 30% jump in the revenue outlook. But then right on the bottom line, they posted this unexpected GAAP net loss of $92.1 million.
I mean, that's negative 40 cents EPS. How does a company raise its full-year revenue outlook by 30% while suddenly bleeding $92 million in a single quarter? Something must have broken under the hood.
Well, nothing actually broke. They basically took a sledgehammer to their own infrastructure. That $92.1 million loss is almost entirely driven by one-time charges.
Okay.
The core operation is healthy. Adjusted EBITDA actually stayed positive at $44 million.
So where did all that negative cash go?
The bleed came from $15 million in legal settlements, $13 million in acquisition costs, and crucially, a $33 million restructuring write-down.
Wait, $33 million just for restructuring?
Yeah, they are intentionally throwing away the assets tied to their compounded GLP-1 supply chain.
Okay, so for anyone listening who isn't deep into pharmaceutical logistics, compounded essentially means they were custom mixing generic versions of weight loss drugs. Walking away from a $33 million investment screams of a massive strategic pivot.
It is a calculated sacrifice to scale faster. So they announced a pivot in March away from the regulatory gray area and, the bottlenecks of mixing compounded drugs in-house.
Right, they partnered directly with Novo Nordisk.
Exactly, to offer the official branded Wegovy pill and pen. Scrapping that compounded supply chain removes their internal capacity limits completely. It gives them the sheer volume backing of a global pharma giant.
That makes total sense. You trade the higher margin but risky DIY operation for limitless scalability. And the early data shows the volume is definitely there, right?
Oh, absolutely. They fulfilled over 125,000 Wegovy shipments in just the first 6 weeks.
Wow.
Yeah, that pivot alone expanded their total addressable market immediately. Total subscriber growth is up 9% to nearly 2.6 million.
And they are tracking to add over 100,000 new subscribers per month just in the weight loss specialty. That immediate success really explains the hyper-confident tone from management.
Definitely. On the earnings call, CEO Andrew Dudum flat out stated they are pulling away from the field.
You can really hear that swagger in how they are deploying capital right now. They aren't just sitting on cash. They built a 40-person AI team to deploy what they call clinical co-pilots.
Right, which basically means AI is drafting contextual responses for care coaches.
Exactly. So the staff can handle significantly more patients without losing quality. Plus, they're dropping $240 million to acquire Eucalyptus.
And Eucalyptus gives them immediate expansion into Australia, the UK, Germany, Japan, and Canada.
It's a massive footprint.
That global footprint is the critical foundation. By scaling geographically and using AI to drastically reduce the cost of care delivery, management vehemently reiterated their 2030 targets,
Which are $6.5 billion in revenue and $1.3 billion in adjusted EBITDA. But that brings us to the valuation disconnect.
Yeah, it's pretty stark.
Looking at the reverse DCF analysis we have for this deep dive, the market is pricing HIMS and Hers like a stagnant regional utility company, not a hyper-growth AI health platform.
Just to quickly contextualize for you, a reverse DCF isn't about predicting the future. It is working backward from the current stock price to see exactly what growth rate the market has already priced in.
Right, so it gives us a mathematical reality check. Since their current GAAP earnings are negative, we use EBITDA to gauge their operating power. Right.
Yes. At their current enterprise value of roughly $5.93 billion, the market's pricing implies an EBITDA compound annual growth rate of just 5.4% over the next 10 years.
A 5.4% AGR. That barely beats inflation. It implies EBITDA growing from $312 million to just $529 million by 2036. But if management actually hits that $1.3 billion EBITDA target by 2030, it requires a 33% AGR. That completely shatters the market's highly conservative expectation.
So the core echo for investors today is that HIMS and Hers is intentionally trading short-term, on-paper GAAP profitability for massive global scale.
They are shifting from a simple telehealth site where you just get a single prescription into an AI-driven, closed-loop healthcare ecosystem operating across 5 continents.
Exactly.
Before we wrap up, here is something to chew on that nobody on the earnings call brought up. If HIMS and HERS successfully builds this closed-loop AI-driven global system, they aren't just competing with other digital health startups anymore.
They're quietly laying the infrastructure to replace traditional primary care altogether. I mean, if you can get branded medicine, AI-assisted coaching, and global access right from your phone, why would you ever sit in a waiting room again? And finally, the obligatory disclaimer: all content in Earnings Echo is AI-generated information and does not constitute investment advice. Investing involves risks. We assume no liability for your investment decisions. Do your own research before taking action. Numbers checked, portfolio prep. Catch you again soon.